totally fine. So I'm hoping that a couple more people will join, but we can also just get started.
Well, if there are a bunch of there's realtors too. You also got to realize realtor time, right? So you got to give them a goal, 10 more minutes.
Nah, Jaden's on time. She's a realtor.
Oh, good job, Jaden.
I know sometimes I'm personally guilty of this where I'm like, oh, that's a great webinar. I should join that. And then I register for it and I don't show up because it's at a time or like something happened and I want to go do something else and then I just watch the recording afterwards. So that being said, I think we just get started. How do you feel about that?
Yeah, I'm good for you on first
Cool.
part's introductions anyway. So
Yes. All right. So welcome everybody to Maximize Your Income, Minimize Your Tax Liability. We're looking at tax strategies and loan options for the self-employed home buyer, also for real estate agents. And I'm Ellie Margulies. I am the emotional support lender with Cross Country Mortgage. And we've got Mike Ross here, who's our tax expert and bookkeeper with Northwest Premier. So today you're here, obviously, because you're self-employed and you're interested in maybe buying some real estate, or you're a real estate agent and you have clients who might be self-employed. Either way, this information is going to be great and you've come to the right place. And self-employed buyers have a special set of challenges to navigate that honestly W-2 buyers just don't. So whether you're self-employed as a real estate agent and you're also trying to buy your own home, or whether you are a 1099 contractor or a small business owner, you're going to have a special set of challenges to navigate while going through the home buying journey. And today's webinar is going to discuss several different loan options for self-employed borrowers, as well as some of the tax strategies that will complement each one of those. We're going to do a high-level overview of this information. Keep in mind that we do not expect you to become the expert in any of this stuff. This is just like a high level. I want to tickle your brain and make you think, oh, okay, that could be good for me. But the real purpose here is to encourage you to build a really strong relationship with your lender and with your tax advisor and your tax strategist, really, and to use us both as partners throughout the year and not just when it's like pedal to the metal go time. The sooner that you can start this conversation, the better. So we're going to do some high-level introductions, some self-employment financing and common pitfalls that I see all the time in the market. We're going to go over some different self-employed loan programs. And then I'm going to pass the mic over to Mike, and he's going to talk about tax deduction philosophy, leveraging business entity structures, and strategies that may or may not help you qualify for the house or property that you're looking for. And ultimately, we want to leave it open for some questions and answers at the end. So these are my two dogs. This is the farty one. She's laying on the bed behind me. And this is her nephew, Odin. This is Jaya and Odin. She's almost 13. He is 7. And I bought my first home in 2012 because I loved having pit bulls and I realized how hard it was to rent anywhere with a dog like that. So I bought my first house when I was 25 and it absolutely changed my life, like literally in every way. I bought it in 2012 for $194. I sold it 3 years later for $350,000. Today it's worth $850. I always say, like, I've made some questionable decisions in my life, but the one I regret the most is selling my first home. So I want to help people feel empowered to make those decisions and understand what all their options are. And also, it helped me recover from a lot of trauma in my teens and helped really make me feel like I could make that happen for myself. All my friends thought I was crazy, but I made it happen, and it absolutely changed my financial life and how I felt about myself and the future trajectory of my life. And so as your lender, your dream is my dream. If you have the dream of home ownership, then I am here to make it happen. And I love guiding people through that really exciting journey. I partnered up with Mike Ross of Northwest Premier. Growing up, he started his career really young, baling hay in the summer, and we all know how hot and sweaty that job can be. This experience truly taught him the value of time and money. And after graduating from WSU in 2016, he really made it his mission to align himself with a company that would enable him to give back to people, helping others make the most of their hard-earned dollars and get more time back in their lives. Unable to find a company that really truly made him feel like he was coming home, He found Nathan Gans, and eventually they partnered together to create the company that they have today, Northwest Premier Creative Financial Solutions. Northwest Premier is also the go-to bookkeeper and trusted financial advocates for real estate agents and small business owners all across the company. They're based in Washington, but they serve many, many different states. And they've quickly become an authoritative voice in the bookkeeping and tax strategy space, as well as they've written a #1 best-selling book on the topic, The Financial Blueprint for Real Estate Agents. Northwest Premier really does stand out against their competition and other people in that space because they're so creative and so proactive in their approach to their craft, and also how they approach their clients' books and get really creative and forward thinking as opposed to just being reactive. So it's been super fun working with him putting this together. So let's get down to business. We're going to again talk about common pitfalls, self-employed financing options, and our overview, and self-employed loan programs. But first, I wanted to put a poll in here, but I'm technically challenged every once in a while. So I was thinking I'd have a larger audience, but I already know what you guys do. I was going to say, drop what kind of business you have in the chat. But we know we have a financial advisor. And oh, Butter, I don't know who you are, but can you please drop in the chat where you're joining us from and what kind of business you are, whether you're a real estate agent or you are a self-employed business owner. So I'll give you a second to drop that in the chat if you would be so kind. Maybe. All right. Well, we're going to keep moving forward. So financial readiness, we really want to help you understand your options, strategies, and how to avoid some of the common challenges that I see in the market every day. Again, when people come to me as a self-employed business owner, I love helping them achieve their goals and dreams because it's so exciting. Fan Jose, oh, hey, Jay, good to see you. Okay, so yeah, a lot of the times people are really challenged because they're lacking documentation and organization. The number of times I have to like ask a client, hey, can you send me this, this, and this, or they don't have their taxes in paper form, or they have to go back to their CPA to ask for their taxes again. Lacking documentation and organization can truly hurt you when you're looking to buy a home. A lot of the times they'll not really have any tax strategy. I actually just had a really sad thing happen. I'd been working with these borrowers for a number of months. They knew that they were going to be able to show more income on their taxes this year, but they didn't tell their CPA that they wanted to buy a home. So their CPA prepared their taxes, they wrote off everything, saved them tons of money, but it disqualified them from being able to purchase a home this year. And so really having a strong tax strategy, and this third one of lack of communication with make sure you're communicating these things. And that's something that we're going to talk about more with Mike as we go down the road, why it is so important to have a strategic tax partner, not just somebody that does your numbers for you once a year. The other things I see, writing off too much, kind of like my previous clients, they wrote off everything they possibly could. And maybe that's a strategy that you do want to use, but in that case, it did hurt them. Or missing write-offs. Maybe they're paying too much taxes and they could be writing additional things off, saving themselves some more money. And last but not least, sometimes we do see businesses that are truly in the wrong business entity because we just don't know better. You know, we're getting started, we're a year or two in, and we just don't know better than, you know, we're a sole prop and that's what we thought we should always be. So we're going to talk about business entities in a little bit as well. So really people fall into two main camps when they're looking at their taxes. But we know that there's actually so many more like facets to the diamond of taxes. So there's kind of two camps though. People either claim everything or they write everything off. When you claim everything and like really claim all your income, you're going to look better on paper. This might be the strategy that you want to take so that you can qualify for conventional financing. Conventional financing does have lower interest rates. They also have, you know, first-time homebuyer benefits, as well as some access to down payment assistance programs that you can't really layer on top of the alternate document loan programs. Now, on the other hand, they do have a higher tax liability, but we're also going to talk about when it may or may not be appropriate to, you know, suck it up, pay some higher taxes, and, you know, maybe that's what you need to do for a year or two. Now, on the other side, people sometimes will take the opposite approach and they're going to write everything off. So that lowers their tax exposure. It helps them retain more earnings. And with those retained earnings, they can potentially do other things like grow their business, and or diversify their portfolio. That said, these types of folks are probably going to be looking into some more non-conventional loan programs, or what we call alternate doc programs. We're going to get into that here in a second. Now, a little caveat here, it's all going to depend on what kind of business entity you have. So we're going to do high level types of loans. Bank statement loan is going to be our first one. So bank statement loan, what we're doing is we're collecting usually 12 months, sometimes 24 months of bank statements, and we are adding up all of your qualified business deposits. Now, you can also use personal bank statements for this. Maybe you're a sole prop and you haven't divided your accounts yet, and you're just, all of your business money is going into your personal account. We can still take a look at that too. But what's going to end up happening, because we're not looking at, your taxes or your P&L, we don't know, there's no way to show what the expenses are to your business. So in this example, for a bank statement loan, there's something called a 50% expense ratio. Let's say you have $400,000 in deposits into your business every year. We're going to only take half of that, so $200,000. And in this example, that would give you around $16,000 in income every year. With this program, depending on your credit score and your the type of home you're looking to buy, your down payment's probably going to be anywhere from 10 to 20%. And I see a lot, like pretty much any business can use this one, but I do see a lot more sole proprietorships and LLCs use this program. Next up, we're looking at a profit and loss loan. So we are taking a look, we're not looking at your bank statements, we're really focused on your P&L. We're looking at that cash flow versus your taxable income. And this is catered typically to more established business that have really clear profitability. There's no expense ratio in this one. So we're truly just going off your cash flow. It does allow for various income sources and multiple revenue streams, but it does need to be prepared by a licensed CPA. This is really great for somebody that's got robust profit margins, but writes off everything, kind of like what we were talking about. And again, same idea, it's going to be 10 to 20% down for your down payment. 1099 loan. This is really great if you are like fully a contractor that only gets 1099s. We're going to look at 90% of the gross 1099 income average for the last 2 years. So that one you'd have a pretty great expense ratio because we're taking 90% as opposed to that 50%. We do require, the last 2 years, like all of your 1099s for the last 2 years, as well as a documentation of your year-to-date income. And the CPA does need to also issue proof of business, including your active business license and your business insurance. Typically, you're looking at a down payment of 15%. You could get away with 10 in some circumstances, but 15 is a pretty safe bet. And contract travel, like nurses or occupational therapists, anyone that's in that sort of travel contract vibe, typically do really well with this program, but any contractor that is getting 1099s would also do very well here. And last but not least is a DSCR investor loan. So this is a loan where you are not able to live in it as a primary residence. This is purely for investment purposes. And it stands for debt service coverage ratio. And what this means, it's pretty cool. It's not looking at your personal income at all. So it doesn't matter how much money you make. What this loan is going to qualify you based on is how much rent that house will generate, or that multifamily complex will generate, in comparison to what the mortgage payment is. So depending on the type of house, your credit score, and the DSCR ratio, so like does the rent cover the mortgage, or is it more than the mortgage? Is it less than the mortgage? That's really going to determine what your down payment is. Typically, you're looking minimum down payment is 25%. That's with like a 740 credit score on a single family home. If it's a duplex, it's probably going to go up to 30%. If the DSCR ratio is below, meaning that the rent does not cover the mortgage, you're going to be looking more at like 30 to 35% down payment. So there's a lot of variability with this one, but and again, the interest rate's around 9 to 10.25%. But if you're an investor, this is an awesome opportunity to not have to show any of your income and qualify it simply based on the property and what that property's rent roll looks like. Pretty great opportunity. I love it. So before we dig into Mike's portion of tax strategy, we're going to take one more little poll. For those of you that are here today, will you please drop in the chat, what business entity are you today? Sole proprietorship, LLC, partnership, S Corp, C Corp, S Corp. Love it. Sole proprietorship. Jaden, we got you. Hi, Juan. Seoul. Okay, cool, cool. Juan, where are you joining us from? San Diego. Looks like we got all California in the house. I had so many people from Washington register and nobody is here today. That's okay. Juan, what kind of business entity are you? Maybe, maybe not.
No, he said sole provider.
There it is. I probably have a little bit of a delay. Okay, cool. Well, this is really exciting. I'm gonna pass it off to Mike. He is the tax expert. I've learned so much just working with him on this presentation, and I'm really excited to share it with you guys. So, as we go through, also, does anyone have any questions on the loan stuff before we go and get into this? I would love to have more questions and stuff at the end too. So please take notes and let us know, like, if there's something that is just a burning question, we definitely want to answer it. We're going to leave some time at the end. All right, Mike, I'm going to let you hop into it. Let's go, buddy.
Yeah, sounds good. Also, to be fair, if you had a lot of Washington people sign up, it's like the first sunny day it's been in
Oh, yeah,
almost
that's
2 weeks,
definitely why. That's
or
why.
probably 2 or 3 weeks. So it's the sun's out. I'm sure there's people on their bikes. They're going out and doing something right now. So
I did have a couple people text me like, "Hey, sorry, I'm not going to make it. I have to go outside," which is
yeah,
I'm all for that.
it's very rare right now. It's our one opportunity to get some kind of tan before we go back
Yeah,
into the heat for another couple weeks.
totally.
All good. Anyway, yeah, so it's nice to meet everyone here. My name is Mike Ross, one of the owners of Northwest Premier Creative Financial Solutions. And our mission is to be the go-to trusted financial advocates, real estate agents, independent contractors, and small business owners across the country. Now, we do that within our three main departments. We have our business planning department, financial consulting department, and then what we're most known for is our bookkeeping department. Within our bookkeeping department, we pride ourselves in three main areas. The first one is communication. Second one is visibility. And then the third one is finding missed opportunities. Now, we're all salespeople here, so I'm just going to dive into the sales pitch right off the bat. The average real estate agent and the average independent contractor who works with us gets a 10% raise just from our creative tax strategy alone. In fact, right now for April, we're running a whole promotion. We're saying if you're an S corporation and we can't save you a minimum of $3,000 in taxes, we will give you guys $100 right there on the spot. So we're that confident in what we do. We love a challenge, and as you can tell from my shirt, taxes do suck. But if you know the game, they won't suck as bad as you think they do. So let's dive into it. Ellie, next slide. All right, so on today's agenda, as she mentioned, we'll be going over why proactive tax strategists like ourselves are important. We're going to go over a case study of us saving a purchase for a real estate agent and a loan officer. We'll also go under understanding write-offs more in depth, as well as your business entity strategy. Now, because it is a smaller group today, when it's a small group like this, I really like to keep things super open and more of a communication in the communication department. So please, if you have a question, drop it in the chat. I can cut in and out of a presentation here pretty easily. But I want to make sure that you guys all showed up. I want to make it as most valuable for you guys as we can. So please stop me at any time. But without further ado, let's jump into the meat of the presentation. So next slide, Ellie. All right, so let's just go over the case study real quick because I want to give you guys a real life example of something that's happened. So we had a business owner come over to Northwest Premier. They were already under contract. They did not have a tax strategist partner. What they had was what we call a tax filer. So there's a difference between a tax strategist and a tax filer. Tax strategist actually talks to you more than probably like 2 times a year. So probably like 2-3 times a year, or they're bookkeepers who talk to you each and every single month. A tax filer is someone who you meet with once a year. You drop off your stuff. They ask for documentations. You do it. They file it. Off it goes. And that's the end. This person, unfortunately, had a tax filer, and they went to their CPA because what they needed was, after they got approved, they needed an updated profit and loss statement. And during the underwriting process, they realized it wasn't all there and up to date. So they went to go to their CPA to get the documentation signed, but they couldn't get a hold of their CPA. So they called another CPA, and they called our company. And I said, yeah, let me introduce you to one of our CPAs. Our CPA took a look at their work and said, this is the books are terrible. The numbers don't make sense. I'm not putting my license on the line and signing off on this. Tough luck, pretty much. However, he said, if you guys can get in there and clean the books up, and make everything look accurate and to date, I will sign off on it. So a challenge was presented and we attacked it head on. I pulled off some bookkeepers from other projects and we all jumped in. Long story short, we had a week to do it. We cleaned up a year's worth of books to get it all dialed in for them to be able to close on their property with 1 day to spare. The guy got into the house, the real estate agent got paid, loan officer got paid. The guy and his family got to move into their brand new home and celebrate their daughter's birthday that weekend. So that's pretty badass. So I was very happy about that. It was a win all around. Everyone was happy. And now he's a lifetime client, working with us each and every single month. So we proved our worth there. So I was really happy about that. Through this presentation, again, we'll dive more into details, but that's just a really good case study I'd like to bring to your attention on why bookkeeping and having a tax strategist is so important to have on your side. Okay. All right. First off, let's dive into just the basic foundations of taxes. And I want to ask you guys a question. If you could put it in the chat or unmute yourself. What is a tax deduction? And I'll give you 1 minute to answer maximum. I can't see the chat, by the way. Let me see if I can pull that up. Okay, there it is. All right, anybody in the chat, you can mention it. What is a tax deduction?
Business expenditure. All right, nice.
That's part of it. Anybody else got more? Do you want to add on to that? Financial advisor in the room. You want to give it a shot? That's what I like about a nice smaller class. I can just kind of pick on whoever I see. All right, well, I'll read you the exact definition. Here it is. The exact definition is the tax deduction is a business expense that lowers a person's or an organization's tax liability by lowering their taxable income. Okay. Well, wait, did you get it? Alex, let me see. Is that you in the chat? There you go. Yes, that works. So a combination between the business expenditure and a subtractor from their top line revenue. Yes. So once you find deductions that lowers your taxable income, it's just an expense, a business expense that goes out. So that's pretty cool. Basic foundation. Just want to make sure you guys know that and understand that before we dive into more. So next slide. All right, let's go into 2 key reasons on why you want to use a tax deduction. Now, the first key reason why you want to use the tax deduction or find more business expenses is the obvious one, which is to lower your current tax liability. So let's say you have $150,000 of gross revenue. So that's how much money you made in sales. And you don't want to pay that high a tax bill. So you go and find all the deductions possible, like your car insurance or, cost of goods sold, so what it took to make it. If you're a real estate agent, like listing photos, hiring contractors, you name it, you went and found as many deductions as possible to lower that taxable income. That's one of the key reasons why you want to use a tax deduction is to lower your tax liability by lowering your taxable income. Okay? That's the obvious one. However, the second one I think is more important than the first. And this one is to accurately calculate the difference between, for realtors, gross commissions, for non-realtors, gross revenue, and personal income. This is the #1 reason why I see business owners fail in the first couple years, time and time again. And the reason is they do not know the difference between gross commissions or gross revenue and personal income. Every time you make a sale in whatever your business is, the moment it comes to you, that is not all yours. Okay. I think you said there's a DJ in here too. Just the gas it took to get to the venue, right? Maybe you had to stop and you had to get some food on the way up there. So you're all ready to go for the event, right? Or if you have a tire blowout, you need to get your tire fixed, or AAA and stuff, whatever it is to get to the venue costs you money. So every single time you get paid, you also have something called, taxes that you owe as well at the end of the year. So you need to accurately calculate how much expenses went out in order to generate the income that you brought in. And the only way to do that is to use tax deductions or track your business expenses. If you are a business owner, which you all are, and you do not know your numbers, at some point you will fail in the business because you will not know how to double, how to grow, or how to expand your company. Okay. So I know it's a little harsh, but you need to know your numbers. I'm telling you, just even if it's not with us on a bookkeeping, you can get some of the random software. Just please know your numbers by tracking your deductions, tracking your expenses. Okay.
Jeez, Mike.
I know. All right, next one. We'll go into some fun stuff here in a second. All right. I just want you all to be successful. So I know I just want to hit home how important that is. Otherwise, you'll be salespeople forever. And I want you guys are all business owners by default, whether you like it or not. So I'm excited for you guys to grow and work with you and partner next to you as that happens. So the other two reasons, or the next thing is 2 reasons why you do not want to use a tax deduction or use all the tax deductions available. And number 1 is lending. I'm sure if you're a real estate agent, or Ellie's experienced this before, you've worked with someone who says they make all this money, and then you show them homes or you talk about goals and dreams, and then they go to get pre-approved, and you actually find out they made nothing. And the reason is they used all the deductions humanly possible to lower their taxable income. I'm sure
have you ever had that happen yet? Working with those self-employed borrowers?
No, I actually haven't worked with any self-employed people
Oh,
yet.
well, here you go. We're going to get you all ready before you do.
Yes. So if you anytime my favorite thing is numbers don't lie, right? You can never bullshit the numbers, which I love. So if somebody says they make all this money, once you get those tax returns and documents, you'll see the truth of what they made. So somebody may say they make $200,000, but they wrote everything off. They have, $190,000 of expenses, and their taxable income is $10,000. So that's what you're getting approved for. Okay. So be careful on overusing tax deductions. Know your goals. Again, hitting home why it's so important to talk to a strategic tax planner or a tax advocate like us, like bookkeepers, your financial advisor, or a CPA. Everyone needs to know of your goals because they do change. One of the questions I ask every client that comes on board for us is at the very beginning, I say, do you need to show a certain amount of income each year in order to hit your goals or to qualify for loans or business loans or homes or whatever? I have one client that we need to show $100,000 minimum every single year so they can qualify for the investment properties that they're looking for. So that's our goal. We will always find every deduction we can to make sure they hit $100,000 every single year. So that's one of the questions we ask. So again, you may not want to use all your tax deductions, so you are lendable to people like banks and people like Ellie. All right, financial advisor, just turned off a camera, but this one's for you. The next one is the reason why I don't want to use all your tax deductions is for covering for maximum protection. Now, if you don't know, or if you've never been, when you were a W-2, do you guys remember getting something that was called benefits? You used to get health insurance, life insurance, disability insurance, 401ks. You guys got all that handed to you at the beginning when you were W-2s, right? That was nice. However, now that you guys have ventured off and to be entrepreneurs, you don't have that anymore. And if you do have it, it's because you went out and found it. So you need to get your own benefit packages now. You need to find life insurance. You need to find disability insurance. You need to find 401ks or retirement accounts, right? You need to go get your own thing, all your own stuff, own health insurance, all that. However, guess what? These insurance companies base how much they're going to protect you on. If somebody in their head said it's based on income, you are correct. It's based on income. Because if you say I make $200,000, they will protect you for $200,000. But if they get the tax returns and you used $190,000 of deductions and you're showing $10,000, they're going to say, why am I protecting you for $300 when all you're taking home is $10? So you're not going to qualify for anything. So loophole. If you need to buy a property or you want to buy a property, invest in one of the greatest assets known to populations ever, and buy real estate property and show a certain amount of income or show a higher income level, why not double down and also apply for maximum protection? Go talk to a financial advisor or an insurance broker who can do life insurance and disability insurance and qualify you for that high income that you're showing. Because the worst thing that could happen is if you show high income, pay more taxes to get into the home, and then next year you talk to your advisor and they say, hey, you need life insurance and disability insurance, and then you have to show high income again 2 years in a row. Now you're paying more taxes unnecessarily when you could have all done it at one time. So hopefully that helps. Lending purposes, maximum protection, those are reasons not to use a tax deduction.
Alex also talked about maxing out. I was just thinking about that. And I wonder if Alex is going to say something, but maxing out your 401k and your SEP IRAs.
Yes, I think you have until what, the 15th or something, or the 11th or something to do that, Alexandria, for 2023. Yeah. Yeah, it's got
Time
your
is coming up. We only got a few more days.
Okay, so if you're here and you're able to take a screenshot, again, for time's sake, I don't want to dive too much into this, but here are some pretty cool write-offs that you can have as owning a home. So if it's your primary home, you can deduct and you own a business, you can deduct your mortgage interest, real estate taxes, property taxes, home equity loan interest, so HELOC. Some home repairs or improvements are available to deduct, because if you do work from home and like 10% of your home office is, or your office is used in your home, you can deduct 10% of your utilities, 10% of all the other stuff that goes with it. Mortgage points and some upgrades and efficiencies if you're going to build like an ADU and stuff on there as well. If you're owning an investment property, you can deduct the mortgage interest, the real estate tax, property taxes. Again, another HELOC, some home repairs and improvements for sure, because you're always building it to make it more valuable and to make more people want to stay into it if you have an Airbnb, long-term rental, or whatever. So those are way more valuable and way more deductible if you have an investment property. So make sure you're capturing those as well. And then you can also capture business losses. In fact, real estate agents, side note, real estate agents is the only occupation in all of America that can actually deduct losses on rental properties and deduct those against your active income. So if I spent $30,000 to upgrade my rental property and I lost money that year for myself personally, I cannot go lower than zero on my taxes. If you're a real estate agent and you had a $30,000 loss, you can deduct that against your taxable income. I can't. So if you're a real estate professional, you get the extra benefit of using losses on your rental properties that nobody else gets. So that's pretty cool. All right, let's dive into the next stuff. Entity selection. Okay. You guys all typed in here. We got 1 S Corp and we got 4 sole proprietors, correct? So let's dive into the fun stuff. These are the options you are presented with when you are starting your own adventure into the entrepreneurship world. You can choose sole proprietor, partnership, S Corp, C Corp, or an LLC. If you don't know which one you were at the beginning, well, guess what? By default, every single person is a sole proprietor. A sole proprietor is simple. However, if you haven't filed taxes yet, actually, and can you drop in the chat how long you guys have been in business for? Because that would actually help me a lot to understand how much time I want to spend on each category. Have you been in business for a year, 2 years, 3 years, 10 years? Okay, 2 years, 1 year, 2 months. Okay, 3 years. Okay. So you guys have gone through a couple tax seasons already then. 8 years. Okay, yeah. So you guys have definitely been through some tax seasons. If you're filing as a sole proprietor, the 4 of you on here, sure that when you're looking at your tax return and you have a high tax bill, majority of that comes from this really, really nasty tax that's called self-employment tax. Self-employment tax is 15.3% above your state taxes and above any other taxes you're paying being in California. It's above all the, and your income taxes is above that. So it's 15.3%, and that is a killer of most business owners. So if you made $150,000, you made $100,000 take home, you're getting hit with 15.3 right off the bat. So we'll dive into that more in a second. Partnerships, seeing as how no one mentioned that, I'm not going to dive into that again for time's sake. I don't see this too often anyway, the real estate agents or most business owners. The S Corporation, we'll dive into that in more particular too. C Corporation, so fun fact for any real estate agents on here, a C Corporation is something you're going to want to be because they do not recognize you as an LLC in the state of California if you're not a real estate broker. But again, we'll talk about that offline. I just want to get the general concept of it through across to you guys. The jack of all trade in most states is the LLC, and that's how you can file as an LLC, C Corp, S Corp, partnership, or sole proprietor. So here's the reasons why you want to choose which one. Next slide. So as a sole proprietor, we're going to run through the same scenario with different details in each of them. So you're filing as a sole proprietor U4 that we just mentioned that. Your gross revenue is $150,000 for the year. Okay, that's how much homes you sold. That's how much music or people paid you for being a DJ. That's how much money came into you going out there and doing your trade. You received $150,000 gross revenue. That's not all yours, but that's what you made. Okay. Then you did proper bookkeeping. You tracked your expenses, and for easy math sakes, you found $50,000 of expenses. Okay. So you went from 150 to 50. So your take home, your net income is now 100,000. You don't have any wages coming out of that because you actually have to have payroll if you're an S corp. Big, big, big myth in any business owners is they say they move money from their business account to their personal account, and they call that payroll. That is not payroll. That is called owner's distribution. If money goes out of your business account into your personal account, that is called owner's distribution. If money goes from your personal account to your business account, that's called owner's equity. Okay. Sole proprietor, no wages. You have the self-employment tax of 15.3%, which is $15,300 that you are paying to the IRS right off the bat just from showing $100,000 of income. That sucks. $15,300 goes to the IRS before California takes their state tax, before you have to pay for all your expenses, before you're paying for any living expenses in general. Yeah.
Hey, sole proprietors, do you feel that crunch? Have you felt that ickiness before where you're like, my tax bill is what? I'm sorry. Let me know.
Yeah.
Hey, Sarah. Sarah just hopped on.
Hey, the one who made this all happen.
Yeah. Hey, girl.
So I'm sure you guys have all felt that pain. If you haven't yet, I'm take a look at your tax bill this coming year because taxes are due in a week from today. Okay. You can either file so if after this presentation, you're like, wow, I feel like I don't want to pay this high tax bill. You give us a call. We'll make sure you get an extension with your CPA or one of the CPAs we work with will get you an extension. And then we can work on your books together and make sure you're paying the least amount of taxes possible for you and or strategize to make sure you're able to qualify for a home with Ellie or just figure out 2024. Perfect. Yep. 20%. Yep.
Hey, Juan, I just saw your message. Nice.
Yes, I do know how you can do an S corp. So let's talk offline about that because I'm going to do a high overview right now. But for you, yes, there's different ways to make you an S corp.
Thanks for sharing that. That's really, I love that you came out and just got right to it, Juan. I love that. So if anybody else has any questions, be like Juan, drop it in the chat. We're here to have this like nice intimate conversation. So hit us with your question.
Correct. So we all agree self-employment tax sucks. Okay, that's a general concept of that. So we don't want to pay that as much. However, to Ellie's point earlier, if we deduct, in our point earlier, if you deduct everything to lower that tax bill, you show no income. Now, Ellie can do some waiver wand with a couple of things that she was mentioning about different loan type programs. But if you want to do it in a more clean way, this is what you do. You elect your LLC or your C corporation. Juan, we'll talk about that in a minute. If you file for an LLC or C corporation, you can elect that entity structure to formate and file as an S corp. So you can be an LLC and be an LLC filing as an S corp or sole proprietor, or you can be a C corp filing as a sole proprietor or filing as an S corp. Regardless, you need one of those two entities, an LLC or a C corp, to be able to pull the trigger of filing as an S corp, which allows you to have the next two options. Scenario number two, you still made $150,000 that came in. You found $50,000 of expenses. You have $100,000 of take-home taxable net income. However, you talked to us. We found you a way to become an S corporation. We said set your salary at $50,000, and then you take $50,000 of distributions. Here's what that means and why that's important. That $100,000 that you see on the net income line right here, that is now split into two categories. Again, wages and distributions. Wages, which is also known as payroll, that unfortunately still does have 15.3% self-employment tax. You just can't get away with it. But the government wants you to have a quote unquote reasonable salary for your company. Okay. So we just, for simplicity, we made $50,000 in wages, and then the other $50,000 goes into profits or distribution. Any profits of the company or distributions of the company, in that category, there is no self-employment tax. So you're saving 15.3% on any money up to like $168,000 that goes into the distribution or profit side of the company. So in this scenario, you put $50,000 in your wages. So $50,000 was now profit. You do the same math, times that by 0.153, which is 15.3%. Just by talking to us today, if you do this strategy, You saved $7,650 on your tax bill. Same amount of money that you earned just doing different accounting saved you $7,650. Okay. Now let's go to a more real life example. On the very end, again, as I mentioned, the government wants you to pay yourself a quote unquote reasonable salary. I shit you not, that's exactly what they say in the tax code, a reasonable salary. But what is a reasonable salary? Well, we use two ways to be able to determine that. Number one, if you've been in the industry for a long time, we'll take an average of your 3 years and figure it out that way. Or another way we do it is we go to salary.com and you can type in your state, your city, and you can type in your occupation, and they will spit out the number that the average person in that industry and in that occupation makes, and that's the number we go off of. So for this scenario, let's say it's your first year or your second year in business and you made $150,000. It was your, maybe close to your first year, or if not a little better than your last year, the first year anyway. You have $50,000 of expenses, taxable income still 100 grand, but we set your salary down to 30,000 because that's more reasonable for your situation if it's your first or second year in business. That means $70,000 is profit. So if $70,000 is profit, you're saving $4,590, or you're paying $4,990 on the salary side, and you're saving more money on the profit side. So we want to keep that salary reasonably low as possible. That's the key. Now, another huge takeaway from this that I want you guys to write down: when do you file as an S corporation? I'm going to write it in the chat for all you guys so you don't miss it. This is a number. As you're going into your business, and this is you right now, we need to talk. If you're making more than $60,000 in net, so personal income, become an S corp. That's the takeaway from today on this, okay? The reason is, when you're filing as an S corp, you're now paying more in taxes, and they're not taxes, in tax filing, because your CPA now has to file business tax returns and personal tax returns. You also have to add payroll, because those wages, again, can't just be you moving money from the business to the personal account. That's not wages. You actually become a W-2 in your own company, which sounds weird, but this is the way it is. So at the end of the year, you're going to get a W-2 and a K-1. Okay, the K-1 means profits. The W-2 is your salary. You will get that at the end of the year, so you actually have to have payroll. So all in, to file your taxes every year, it's probably going to run you around $5,000 to $7,000 just to file your taxes every year. So if you're not saving a minimum of $7,000 in taxes by becoming an S corp, it does not make sense. That's when Ellie can help you out with more of one of the other loans, because you can't be an S corp. Just doesn't make sense. Okay. The other thing too is Ellie takes in any mortgage company, but Ellie in particular, because you're here now. We'll take
I am the only lender.
Only lender that you guys work with is Ellie, and she will take in consideration the W-2 and the K-1. So just because your salary is $30,000 as an S corp does not mean that's your lending power. Your lending power is still going to be what's left over after gross revenue minus total expenses. So in this scenario, Ellie's still going to see $100,000 no matter what option here you choose. Okay. Ellie, do you want to speak on that or anything?
No, I think we're good. You really you hit it on the head. I think, again, everything is so individual, and we don't expect anybody that's joined here to become a tax expert or a lending expert. And this is really just to kind of get the brain moving. And I hope that your brain is kind of tingling a little bit, thinking, oh gosh, I wonder if that's me, or I wonder if I could qualify for this, or maybe you've been told no in the past, and this is kind of making you think, maybe they didn't investigate these other options. We would just love to have a conversation with you offline and just go over your own specific stuff. Literally everything is so unique, just like each one of us. Sierra, do you have a question?
I was just gonna say, so I'm in Washington State, and I work with Mike with like a lot of my other like real estate partners, and Mike hooked it up with his CPA this year, who's taking care of me because I had to fire my last CPA because they like kind of shit the bed. So yeah, Mike knows what he's talking about, and Northwest Premier is taking care of me this year so that I don't get screwed again. So yeah, he's great for all of your questions, and definitely go to them for bookkeeping, because I totally would have just completely messed everything up this year if it wasn't for Mike. So thanks.
Well,
Thanks,
thanks
Sierra.
for introducing us, Sierra. I really enjoy working with him too.
Yes. So I do want to hit that home real quick too, that we are not at Northwest Premier, we're not CPAs. We're not filing taxes for you. We do the books, right? So our job is doing the books, is making sure you have monthly profit and loss statements. Okay. So you can do accurate financial planning with your financial planner and know what's going in and out of your business every single month. Okay. We also are going to make sure everything's reconciled and good. So if you get audited, we can go to bat for you and say, here's exactly what we did, why we did it. Now kick rocks. Okay. We have proof of everything. We set people up with books online.
I also, Mike, I'm going to just hammer you home because I have a realtor partner that does work with Mike for bookkeeping, and she did get audited, and it was the fastest, cleanest audit. She was like, oh my God, it was so great because her books were amazing and clean, and they were like, yep, you're good to go. So yeah, I know somebody that's been through that with Northwest Premier for bookkeeping, and it was a great thing for her. So
Damn, so you just want to just travel with me next time and you can be my hype man. Hell yeah. No, so that, I mean, again, that's the whole point of bookkeeping, because if you get audited, the number two reasons people, or the two main reasons people fail audits is number one, there's no proof. There's no receipts, there's no bank statements, there's no tracking, there's no justification of why you have that number. Number two, just because you're showing that number in an Excel spreadsheet, you need to make sure it matches with the bank statements to prove that actually happened. So you got to match those two pieces. And number three, people abuse the rules that are there, which we're about to dive into. They abuse the rules and they basically falsify things. Money never moves. They dump everything once at the end of the year, so the IRS knows what you're doing. It's just a mess. So that's the point of us being bookkeepers, working on your side. You guys focus on making the money. You guys focus on doing what you love, and we're going to focus on keeping you, on the straight and path, and also being creative at the same time. All these tax strategies I'm about to dive into in the next 15 minutes, they're not in the gray at all. These are 100% black and white to the T. We just learned how to play the game, and we play it better than anybody else out there. So, cool beans. All right. Now, because we are running up, we got about 12 minutes left. What I'm going to do is I'm going to open up if you want to go to the next slide real quick. I'm going to open it up for Q&A. If not, I can just dive into these a little more in detail just on my own with you guys.
Are you using the Augusta rule, or do you want to talk about this?
We can just skip it for now. I mean, just in case somebody wants to jump in and ask this question that's been dying before I do this.
Yeah.
If not, I'll dive to the Augusta rule, but these are the things we can talk about in the next 12 minutes is the Augusta rule, which is a pretty badass way I'll talk about probably regardless. Employing your family. So if you have kids under 18, this makes a lot of sense. You can hire your family, and it saves you a lot of money on taxes. The correct term is called income shifting. And then if a lot of people always ask me questions about vehicles, what can I deduct on my vehicles? Should I lease? Should I buy? If I buy over 6,000 pounds, those questions. And then also I can show you guys how to deduct your vacations which are no longer vacations forever. They're now going to be business ventures that you're going on. So if nobody has any questions, I'll just dive into the Augusta rule because I think that's the most important one. But I'm going to open it up real quick to Q&A while I get a drink of water and catch my breath. With my giant jug of water. In the chat, anybody want to go over anything in particular?
Jaden, are you writing off like all these things like your car and stuff like that? And you have a good tracking system for, traveling to open houses and meeting with clients and all that stuff?
Yes, I do. And I also own another business on the side,
Cool.
aside from real estate. So it kind of gets to be a lot, but
Yeah. What is your, did you tell me this? Was it a bakery?
yeah.
Yeah,
Yes.
that's right. Yeah. Okay, cool. And do you use like the travel and vacations write-off as well?
I mean, I don't really go on a lot of.
You're like, I'm a double business owner. What vacations?
All right, well, but you have any questions? I can just kind of dive into a couple things. So, Jaden, you said you're a sole proprietor. Is it for both businesses?
Yes.
Okay. Once you get to that point where the S Corp makes sense, or if you think it makes sense after this call, let's talk a little more in depth about that, because the S Corp could be saving you tens of thousands of dollars. And then also when you're an S Corporation, it opens up a whole nother floodgate of tax strategies that you can pull off that people who are not S Corps can't.
Okay.
Okay. So just for you right off the bat, just to earn your trust on that one, I'll do the Augusta rule because that's one of the most popular ones that we use for a lot of our clients. So Jaden, let's say you come to us, we make you an S corporation, it makes sense for you, you're filing now. You now are supposed to be technically having what's called a shareholder meeting once a month. Okay. So here's how easy Augusta rule, and here's what it is in general. So if you want to go back, Ellie, a couple more slides. The Augusta rule is section 280A. And the Augusta rule states that any person in a primary residence can deduct their primary residence, or can rent out their primary residence up to 14 days a year. Any money that comes into you within those 14 days has no taxes on it. That's pretty cool. It came into play because a long time ago, many years ago, the Augusta Masters tournament, which is held in Augusta, Georgia, it's like the big golf tournament. It's like the Super Bowl golf. All these people who lived around the golf course are renting out their homes to PGA players, to sponsors, big corporations, PGA players' families. They're just making a shit ton of money while this tournament was going on for a couple of weeks. At the end of the year, the IRS said, okay, you guys owe us rental income for all this on as landlords for renting out your home. All these people got together in Augusta and they said, actually, technically, Mr. IRS or Mr. IRS, you do not actually, we don't owe you anything. We're not landlords. By your own definition in the tax code, we don't fit landlord definitions, so we're not paying you. The IRS actually agreed and said, okay, fine, screw it. You know what? We'll make the Augusta rule, section 280A. Any person who owns a home can rent out their home for up to 14 days a year. Any money collected, no cap on the money. Any money collected in those 14 days, no taxes. That's the end of it. So anyone can do the strategy. However, the benefit for S corporations, Jaden, is when you're an S corporation in Alexandra, if you're an S corp too, an S corporation, again, is supposed to have those monthly shareholder meetings. You can rent out your primary residence to your business to have those meetings. So you formalize an agreement where once a month, your business will pay your rental or your primary residence $1,000 a month, and or up to 3 zeros, take 3 zeros off the value of your home, and that's what you can use as well if you'd like instead. But you take $1,000 a month, move it from the business account, put it into the personal account, claim it, but pay no taxes on that, and that's $12,000 a year that we can get you out of your business into your personal accounts. Number one, Ellie will still see that $12,000 when you're applying for a home, because this is the only tax deduction strategy that we know of that does not actually lower your taxable income, but you still get the tax savings.
That's awesome.
So, $12,000 a year right off the bat for having your monthly shareholder meeting. You got 2 extra days to play with. So if you host any big parties like 4th of July parties or Halloween parties or client appreciation parties or poker nights or whatever it is, if you do those throughout the rest of the year, if you have 2 more days you can use, tell us and we can use those days to be able to deduct that party, and we can typically deduct it for more than the normal $1,000 a month. So for an example, we have one guy who throws a fat party for Super Bowl, and we do an extra $5,000 that month for him because it's a huge Super Bowl party. So yeah, Ellie.
Alexandra has a question. She wants to know, should she start an LLC for any consulting work that she does, so that she can also write off her vacations?
Yes. So I get the LLC in general for a couple of reasons. Number one, for just cleanliness. If you get an LLC, you file for your EIN number, right? And then your EIN number will allow you to open up a business bank account. And I would just have all the money you make from consulting go directly into that business bank account. And that separates things right off the bat. If you don't want to do it quite yet, then just make sure you're tracking that income really carefully, so you have a separate line item when you're doing your books. And that was the other question.
Is the Augusta rule per owner or a total of 14 days per the S corp? So like if there's multiple owners.
Per owner.
Cool.
Yeah. So if you own the primary residence, you can use it for 14 days. So the benefit for being S corps is because it's yourself, right? You're your own boss. So that's why you're doing it for the 12 days.
I have a question. So I have a rental property in Washington. I live in California. And my rental property is it's not separate at all. I just have a different bank account for it, but it's not like a business bank account. It's held in my private name. Is there something that I should be doing differently with that income other than just keeping it separate from my current income?
Not really. You want to just any rental income that comes in from any rental property should be in its own bank account.
Yeah.
It's technically what the IRS will call a trust account.
Okay.
So just to keep it super clean, money goes in, money goes out. All expenses are separate from everything else.
Yeah.
Also, you want to do that because if anything happens, that's why it's called a trust account. If something happens on the house, you have to prove that you have the money there to fix it or pay the mortgage if they leave or something.
Yeah. Interesting. Okay.
Yeah. The only thing I'd
Any,
recommend doing is if you have rental properties is to LLC the rental properties because you want them out of your personal name. So if something happens if somebody sues you on your rental property because they hurt themselves,
right.
they'll sue you for the house and they'll have access to your personal bank accounts as well. And you don't want that. You want them to have access to the accounts.
Like I should create an LLC and quit claim the house into that LLC name.
Correct. That's what I would do. You don't have to. That's just me because I just want everything clean, separate. And if somebody screws up in a house, I don't want to have them have access to my personal accounts and or the Northwest Mirror accounts.
And then I could technically do the Augusta rule out of my house here in California to manage my business in Washington.
Correct.
Fascinating.
Yes. The difference is you just don't get the deduction on the business side, but you get the deduction for your personal primary residence. So that works.
Huh. Cool. Awesome.
So,
anybody else have any questions?
Yeah, we're right on time. And then if you want to go to the Q or the end where it has our information, that'd be great too.
Yeah. Oh, too far. We're going to drop our emails and our phone numbers in the chat.
So what I would do if I was all you guys, or Ellie, if you want, I'm sure you're going to send a follow-up email after this. Hey, if we missed you, like blah, 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 and all that stuff. Yeah. We'll send our links in there. I'll have a direct link to be able to set up a meeting with me too. If you don't want to just reach out to the email here. I'll even type in the chat real quick, my number.
Yeah. Type your stuff in there.
Can I ask a question about putting the house into an LLC?
Yeah.
So I'm buying in right now. I'm going through the lending process with a business lender to buy in as a minority owner of my S corp. And so then we were talking about setting up an LLC to dump any like business income into. I don't actually have to show any income for the LLC, but in order to take advantage of deductions, I guess I do, right?
Yeah. So are you W-2 typically, or no, you're an S corp, right? All through and through as a financial advisor?
W-2 and pay one.
Yeah. Okay. Yes. Okay. What's your main concern, I guess, in the whole thing again?
Well, I guess I'm just wondering how to, I guess, protect the house that I'm now going to be renting out to the company. If I don't have an umbrella policy or anything on it, like, should I put the house in an LLC's name as well? And if I'm renting it from the LLC to the S corp, or is that only if you personally own your home?
It's only if you personally, the Augusta rule only works with your primary residence.
Okay, but if my primary residence was as well, I guess you wouldn't want to quit claim your house to your LLC because then you would have to pay yourself rent.
Yeah. So the quick claim or whatever it's called, get my tongue tied. That I would just double check with your mortgage broker, like Ellie or something like that, just to make sure that it's not going to trigger anything. But usually it doesn't, so it should be pretty easy. But I would get an LLC regardless. I love LLCs just because it's just, again, ultimate protection, separates everything. You get a new bank account. Everything keeps, like, what money's made from the rentals goes to rentals.
Credit card points opportunities.
The what?
The business credit card points opportunities. Their offers are always so much better than.
That's true. I know we do have an Alaska card for our business, so we get the companion buddy thing and all that stuff, which allows us to travel everywhere and do these classes. So, I mean, it's really up to you and the amount of risk you want. I mean, to your point, you don't need to LLC anything. You can just get like a big umbrella policy, and that could help you too.
I mean, obviously it varies state by state filing fees, but for the state of California, what's the cost to set up an LLC?
$800. And it's $800 a year.
Huh? Do you know the state of Ohio, or is that too niche?
I don't know the top of my head. I just know that the average LLC filing is about $100 in every other state. The only big state that I've seen more than 100 was Texas at 300, and then in California is 800.
Okay.
In California is $800 a year.
Every year?
Every year you have to redo it, and it's $800 a year. So again, if you're a sole proprietor and you're not at that $60,000 mark, I would just get the umbrella policy until it's time to become an S corp, and then I get a C corp and file as an S corp, because a C corp's only $100 in California.
Okay.
Or you just move to Washington, Ellie and I help you find a house, and then you don't have to pay $100 a year for your LLC.
That's why I
She's moving to
thought
Ohio.
I'm sure it's low there. Is the LLC filing fee deductible?
Yes.
Okay.
Yeah, the LLC filing is deductible 100%.
How many years in a row are you allowed to show negative earnings without any income? Like 2, 3?
3 years. Yeah, I mean, you can show more than 3, but the golden rule is 3. At 3, the IRS is basically like, why are you in business if you're losing money?
Yeah.
So.
Awesome. Anybody else have any other questions? We got Shay and Juan, Jaden. Any other questions from you guys? Otherwise, my dogs are starting to whine at me. Good question. What happens after
If you're
3
going to
years
set
of
up
no
an
income?
LLC,
Nothing happens. Just you're basically on the IRS's, shit list, and they're going to start peeking into it. It just raises more hands than needed. So you can absolutely run it at no income, but again, you're just running the risk of the IRS saying like, why are you in business if you're not making money? But they understand, obviously, business owners typically don't make money for the first few years anyway, so that's why that 3 years is a golden guideline. I wouldn't call it a rule; it's more of a guideline.
Nice.
if you're setting one up, should you set it up like jointly with a partner, or does it like, would it matter which spouse was the owner of the LLC?
Not necessarily. I was gonna say not in Washington or Oregon, but in California, I don't know how that is when if people get divorced.
Yeah, it's also a community property, but
Yeah. You have
Jaden had a follow-up question. Does it turn into a hobby business after 3 years of no income?
Yeah, you could call it that. Yeah. Again, it really depends on what the nature of the business is and stuff. So I guess we talk more offline about that one than giving you a full sure answer that yes, it turns into a hobby business. But I mean, I think deep down we all know what you're using it for, and if you have to question it, if you're like, I'm using it to be a hobby business, but you're just using it for write-offs, I think that answers most of the questions. But we can talk more offline about that and figure out what it is. Because to be fair, I do insurance on the side. I do like life insurance, disability insurance on the side. I don't promote it at all, and necessarily don't. Oops. I necessarily don't want to do it as much, so I don't promote it. So I make a couple, few $100s here and there, few $1,000s here and there a year, from people who know I do ask about it, but I don't promote it. My hobby business, but all my write-offs go into Northwest Premier anyway.
Yeah, awesome. Well, this has been awesome. Thank you guys so much for participating. It's been wonderful having you guys all interact with us. I'm glad that this was a smaller, more intimate group. I'm going to be following up with everybody and sending out the recording. And, we'd love to just chat with you more, even if it's just like a 10, 15-minute conversation. So please do book some time with us. Sometimes I'm a stalker and I'm just going to reach out to you regardless. So definitely engage with us. We're here to answer your questions. Taking care of this kind of stuff way ahead of time is the biggest pro tip and will save you so much time, so much stress, so much anxiety. If you think that it's like a year out, it is not too soon. It is not too early to start having this conversation. So let's get that conversation started and figure out your specific tax strategy and where you're at in the buying process and how you can help clients even more. So we super appreciate you guys coming. And anything else from you, Mike?
No, it was fun. I like doing this stuff. Like I said, I could talk for a whole nother couple hours, but I am getting hungry, so I'm gonna go grab some soup.
All right, you guys. Well, have a wonderful rest of your night, and we'll talk with you all soon.
See ya.
Bye.